Welcome to this IR Magazine webinar, How to Approach Meetings with Hedge Funds. I'm Neil Stewart. I'm editor-at-large of IR Magazine. Thank you very much to our partner in this event. That's Bank of America Merrill Lynch. Now, some assumptions up front, just to give you some context. Hedge funds are back to full strength after taking serious hits in the financial crisis. A lot of redemptions. In general, very poor performance. Took very bad hits, but in Q1 2011, by at least one measure, the hedge fund industry exceeded $2 trillion in assets under management for the first time in history, and that was up 5% just from the previous quarter. Last year, 935 new hedge funds were launched. That was the biggest year for new launches since 2007. And even just in more real time, hedge fund inflows were positive in June, and that's the sixth consecutive month that the industry attracted capital. According to Bank of America Merrill Lynch's Institutional Investor Survey, 63% of investors intend to increase their alternative asset allocation in the next 12 to 24 months. Now, a second point, a lot of these inflows are coming from pension funds, sovereign wealth funds, endowments, traditionally conservative investors. And again, according to Bank of America Merrill Lynch, the shift to direct hedge fund investing has been dramatic since the global financial crisis. And it is particularly true of large pension funds and sovereign wealth funds. Over the longer term, if you look at the global pension fund market, allocations to alternative investments rose from just 5% in 1995 to 19% in 2010. So in effect, you could say that hedge funds are becoming more institutionalized. And one sign of this, of course, a recent sign, is a campaign by the Alternative Investment Management Association. In May, it produced a guide for hedge funds, demanding, for one thing, more transparency. There are also new rules for U.S. hedge funds to register and to report, although in that case the information wouldn't be public, so it's not necessarily a help to IROs. Now, for that matter, a lot of big money managers, traditional big mutual fund companies, are setting up their own in-house hedge funds. So again, you might see, say, Wellington on your share register, but it could be that it's a hedge fund under the Wellington umbrella. Now, another point, there is a sense that, at least in their core holdings anyway, hedge funds are more long-term oriented than maybe they've traditionally been thought of, and investing more long-only when it comes to equities. In fact, in terms of long-short equity funds, they increased their market exposure from 18% net long just at the end of 2010 to 30% net long at the end of Q1. So that's a pretty dramatic jump in a very short time. Again, it relates back to the institutionalization of hedge funds. Many hedge funds that operate long-only fundamentals-based strategies similar to those of pension funds or mutual funds, as opposed to trading around specific catalysts. Now, finally, and anecdotally, we're hearing about a thawing of the relationship between companies and hedge funds, and increasing availability of management. So some questions we want to answer on this webinar today: how to differentiate between different types of hedge funds, and how to get your management team to meet with hedge funds if they're still somewhat apprehensive. Of course, along the way, we'll be very happy to take questions from the audience. You can just type them in the box on your webinar screen, and we'll take as many questions as possible. Now, who is in the audience? We have around 380 registrants in advance of the call, and here's a look at where they're from right around the world. The biggest chunk, around 50%, of course, from the U.S., but we also have a good portion from the UK and from Canada, and a smattering from all around the world. Let's start with a temperature check of our audience. We want to ask a polling question of our audience. So we're going to put up a question on the screen, and please, if you could, select one of the responses. So this is for our audience. How does your management team feel about meeting with hedge funds? A, they'll do it, but it takes some convincing. B, no problem at all, they'll meet with any fund. Or C, there's no desire to take meetings with hedge funds. Now, while you're answering this, I'll mention that this question was asked by Bank of America Merrill Lynch back at their Market Insights conference in March. It yielded some pretty interesting results at that conference. There was well over 100 investor relations professionals there. 44% said no problem, meet with any fund. 45% they'll do it, but it takes convincing. A full 11% said no desire to meet with hedge funds. But let's take a look now at what our audience has to say about this. And it looks like very similar responses to what the Bank of America sample found. If we broadcast our results now, About nearly 40% will do it. Take some convincing. No problem at all. Over 50%. So a good proportion of our audience are enlightened in this area. And a smaller portion, just around 7%, no desire to meet with hedge funds. Now, who do we have to talk about this topic? On our panel, we have two veteran IROs from large liquid U.S. stocks. We're going to hear from Victoria Hyde-Dunn. She's Director of IR at Visa. Before joining Visa in 2007, that was the year before Visa did the biggest IPO in U.S. history. Victoria was 2 years in IR at McAfee and 6 years at Providian Financial, which was acquired by Washington Mutual. And incidentally, she recently completed her 4th term on the board of directors of NERI Silicon Valley chapter. We also have Jeff Smith on the line. He's Director of IR at FedEx. He has primary responsibility for the eastern U.S., Europe, and the Middle East. He joined the FedEx IR team in 1998. Before that, he administered First Tennessee Bank's mutual fund family. So he has more than 20 years experience working with the financial community. Let's go first to Victoria. And Victoria, tell us about your perspective, about Visa's perspective on hedge funds.
Thanks, Neil. My remarks are more overarching as it relates to what I've observed in my career in investor relations and networking with my peers here in the Valley. I would say overall, I think there is a great consensus building up that communicating with hedge funds is becoming increasingly important for investor relations professionals and their management teams. We all know the hedge funds come in different shapes and sizes. It could be a small 5-person company to a 100-person shop. There's short only, there's long only, there's event driven, there's other types of hedge funds. There's some common styles. Hello?
Did we lose somebody?
Victoria, are you still there?
I'm still here, yes.
You can go ahead.
I'm still here as well.
Okay. So it depends on the firm. I think we've also seen a rise in hedge fund activism over the past few years, with management teams being forced to implement changes to their business operations from successful passage of proxy proposals, and even board and management team seat changes with aggressive activism. I think on the other side, well-managed growth companies are gaining long-only interest, where these firms will take a position for several years. I think in general, we can't lump all hedge funds together. As we know, each firm has its own investment criteria and reputation it adheres to. And when all is said and done, I think communications with hedge funds is no different than messaging and talking points we would use with the sell side, retail investors, and other institutional investors. It's all within the context of Regulation FD. I think in the past, many investor relations officers and their management teams could have shunned away from having a dialogue, but nowadays, hedge fund firms are a very important component within a stock's portfolio. They can help be there to support your stock when market conditions warrant it. They can hold on to positions for several years and add to their position during the dips. They can help provide competitive intelligence. They do their research on your industry. They attend your conferences, listen to your earnings announcements, do channel checks, speak with your peers, business partners, clients. It's a two-way street. They're also quick to share with you what they're hearing, even the latest rumors. So I think in closing, just maintaining an open dialogue in the long run is imperative. It takes time to develop a relationship, and you have to invest yourself and your management team to do so.
All right, so that's interesting, Victoria. It sounds like you're definitely seeing this convergence that hedge funds are part of kind of your core investor base and your audience, and you really don't deal with them very much differently from any of your other constituents. Have hedge funds always been an important part of Visa's investor base since its IPO? Yes.
We've been public for over 3 years, and even going back to the IPO roadshow, at the time we did see quite a lot of interest, and to this day we still have many hedge fund firms that have been shareholders since day one of our IPO, and throughout the past 3 years, they've even added to their positions. Some have sold a little bit, but on the dips they've bought back up. So absolutely, and this is international. We do have many holders within the United States, but we also have quite a few positions overseas, especially within Europe and Asia, and even the sovereign wealth funds as well. So yes, from our perspective, we've had a great relationship with the hedge fund community.
Okay, that's very interesting. All right, let's take another question with the audience, a polling question of the audience. So we'd like our audience to participate again. We're going to ask you this question number 2, and that is, what is the primary source of intelligence about hedge funds that you're going to meet with? So when you're doing some research in advance of a meeting, what is your primary source of information? Is it market intelligence from, say, a market intelligence provider like an iPrio or a Thomson? Is it intelligence from your sell-side broker? Say you're working with a corporate access team on a non-deal roadshow. Is it information from them you get? Or is it your own internal research? And while we're asking the audience about this, Victoria, how do you do it? What do you do in terms of gathering an intelligence about hedge funds, whether they're current or prospective shareholders?
I actually would do a combination of all three: market intelligence, sell-side broker, and internal research. The end goal for all of us is to understand, in general, everyone's investment style, the average duration of stock ownership, and anything significant about the firm. So with market intelligence, I think both iPrio and Thomson One have extensive lists of firms in their database, and most likely there's sufficient information on the firm, their portfolio size with assets under management, number of stocks, the sectors they follow, turnover, low or high. Those are some important metrics. They file 13Fs to be able to tell their position within your organization, as well as your peers and your clients and business partners. Sell-side analysts and their corporate access teams are a valuable resource as well. And then also internal research. You can always pick up the phone and call another investor relations officer if they have a position in a firm. You monitor your quarterly earnings conference call and conference webcast attendee lists to note their participation. And at the end of the day, if you can't still find any information on them, when you're talking to them on the phone, just ask. They're more than happy to tell you about the firm and how long they've been in business and what their typical position holding time frame is and why they're interested in your space and your sector. Because ultimately, at the end of the day, you're trying to develop a relationship and have an active dialogue, hopefully for years to come.
Okay, good. Well, let's look at what our audience says then. Let's look at the results of this question now. And it does look, as you said, Victoria, like it's a mix of all three. Mostly, it looks like our audience relies on market intelligence, the type of stuff they might get from a market intelligence provider, but they also rely heavily on sell-side brokers as their primary source and also their own internal research. So a good mix of different sources. And actually, this is a good point at which to turn now to our other panelist, Jeff Smith from FedEx, because it does seem as though IROs have moved past the question of whether or not to meet with hedge funds. Now it's a matter of prioritizing and identifying the measures you use to prioritize. So tell us how you handle this at FedEx, Jeff.
Yeah, I would agree with the insight from Victoria. It's the conversation definitely has moved away from avoidance to prioritization and understanding that, as an IR professional, I will do, conference calls, phone calls, meetings with any investor, whether it's a hedge fund or a long-term buy-side investor or an individual investor. But when it comes to road shows and management meetings, then that time becomes more precious and more valuable, and at that point you need to prioritize and put your best potential investors at the front of the line. And so from our standpoint, we look at turnover, and by definition, if you have annual turnover that's more than 100%, then it's hard to describe yourself as a long-term share owner. And so, those companies with high turnover will be the ones that will be filling in our schedule, but will not be the top of the priority for our schedule. And, at the same time, from a, beyond just looking at those numbers, I'm not going to put anybody in front of my management team from an investor standpoint that I haven't met with and had a conversation with us first, so that I know what their conversation style is, how aggressive they are with their questions. I just don't want to put my management team in a situation where they have to be worried about, Reg FD disclosures. So, those are the two things that I'm going to look at: their turnover, and then having a conversation with them to understand what their questioning style is. When it comes to those meetings, whether it's a sell-side conference or a sell-side roadshow, you've got to always understand that obviously the sell-side many times are going to favor the hedge funds who do more trades with them, high frequencies of trades, and thus pay them more. And when they allocate meetings for you, you have to be aware that they're going to prefer to have a lot of one-on-ones with hedge funds. And what we try to do is group as many of those into group meetings as possible to leave more time, again, for our top priorities, which would be long-term share owners.
Okay, that relates actually a lot to a question that we had from one of our listeners, Jeff, and maybe this is a good time to follow up with this a little bit more. So the question is that top management often associates hedge funds with complex strategies, arbitrage, speculative, event-driven type of strategies. Rightly or wrongly, they perceive hedge funds as volatile, short-term investors, and they may feel that they're being pushed to meet with these sort of short-term players. What kind of arguments can you use to convince the top management to meet with hedge funds, whether it's at a conference or on a non-deal roadshow?
Well, I think historically that might have been a proper description for the hedge fund community, but over in just the 13 years that I've been doing IR, I've seen some of our best sell-side and buy-side analysts move to the hedge fund community, and so that certainly offers some credence to the hedge fund analyst community, and especially those analysts that have moved there that the management team have worked with in the past and have developed a relationship with. So I think that helps, and again, it really comes down to the IR professional doing the proper job of pre-screening, and so that the people that they put in front of their management team, their management team is going to walk away from the meeting, feeling comfortable.
Okay, and from the same questioner, a follow-up question, should we tailor roadshow presentations specifically for hedge funds? And if so, what should we focus on? So if you're going into a meeting with a hedge fund versus a mutual fund or long-only investor, are there different things you focus on? Do you tailor the presentation at all, Jeff?
Well, I don't know that I specifically tailor the presentation. Thankfully, the hedge fund community does have some very sharp analysts who are very focused on your industry and know the ins and outs of it, and will tend to focus very closely on earnings events and corporate development events. But we still need to be able to push through our long-term strategy and opportunities. And so I wouldn't change my presentation, and I would, as a professional, try to always work no matter what their questions are, try to work my responses back to our long-term opportunities and strategies.
Okay, good. Let's do another polling question of the audience now, and this is, Jeff, as you said, it's gone from a question of avoidance to one of prioritization. So let's talk about what are the influences over which hedge funds you decide to meet with. How do you prioritize the funds that you might meet with? So in terms of the biggest influence over which funds that you want to meet with, A, they must be predominantly long only, so not significant short sellers. They must be long-term, low turnover. So that was the measure, Jeff, that you mentioned is sort of the number one thing that you look at, the turnover. Must be a potential investor in our stock. This is something that Victoria mentioned. Oftentimes you get requests for meetings from hedge funds that are just interested in your industry, or they hold your peers, and they may not actually be even a potential investor. So is that a big priority? And for that small portion of our audience that doesn't meet with hedge funds at all, we gave you a D. We don't meet with them at all. So I mean, this is, Victoria, in terms of the specific measures that you look for, you talked about the types of sources of intelligence. Jeff mentioned that, the turnover figure is one he looks at. Is that a big measure for you to look at?
That definitely is one of the metrics that we do look at, and to Jeff's point, I mean, you've seen a lot of musical chairs happen within the space. You have analysts who are leaving the sell side going to the buy side, vice versa, buy side going to the sell side, and even within investment styles, folks are jumping ship or moving around for opportunities between the GARPs and the values and the hedge funds and so forth. So, to Jeff's point, you do spend, if you're in it for the long haul, you spend time getting to know a person and their institution. And if they do leave that institution, they go to another institution, they might pick up interest in your firm you already having spent that time with them. Sometimes it's difficult. You got to start from scratch all over again, and it's fine. It just takes time. But at the end of the day, this is a relationship build job. That's our job, is to maintain relationships with the investor community. And if a price point doesn't work for an investor right now, at some future point it may, and they'll be in there to buy in. So, that's kind of how we've approached it here.
Okay, excellent point. Yeah, so it is a job of relationship building. Let's look at now the results of the question that we just posed to the audience, the biggest influence over which hedge funds they will meet with. And it looks like the number one is got to be a potential investor in the stock at some point in the future, and long-term low turnover. So that turnover number is also very important. So one of the things we asked there must be predominantly long only, and I mean that must be pretty tricky to figure out. In terms of a long-short fund, what kind of intelligence can you get about the degree that they're involved in short selling? This is actually an initiative going on right now with NERI. NERI is proposing to the SEC that there be a system of short sell disclosure, somewhat like long position disclosure with 313Fs. But currently, it must be pretty tough. Jeff, could you respond to this? Like, are there any sources of intelligence, or how do you figure out if a long-short fund is potentially shorting your stock, and to what degree they're shorting it? I mean, is there anything you can do besides simply asking them straight out?
Unfortunately, there's not much clarity out there in the marketplace on people that are shorting your stock. And now I've got a CFA, and I still am lost many times when they different firms are discussing their investment strategy. So, again, I have to base most of my decision making on, one, the conversations that I've had with them. I don't really care if they're going to be what investment decisions they're going to make, as long as they're not trying to pressure my management team into divulging something that would be an FD violation. And then two, again, that they can have whatever strategy they want, but if the reality is that turnover number kind of cuts through all that and really separates the people that are long-term versus short-term focused.
Now, related to that, here's a good question from our audience, Jeff, and maybe you could handle this one as well. And this is, don't you think putting your CFO in front of a hedge fund with short selling intentions could do some good in terms of not only hearing positive feedback? This question says, I don't think the main purpose is to make management feel good. So how would you feel about putting your CFO in a meeting with a known short seller?
Oh, I think that's a very valid point. I mean, we have to put our management team in front of sell-side analysts that have holds and sells on us as well, and hope that they change their perspective. So that is not an issue. Whether they support the stock or not, I don't think is the issue. The real issue is whether or not they expect to make those decisions based on non-public data or not.
Good point. Okay. Here's a good question for you, Victoria, coming in from our audience. Can you talk about merger arbs versus regular hedge funds, so merger arbitrageurs? This questioner says hedge fund meetings are generally quite enjoyable, but merger arbs seem very simplistic in their approach. They just shout a lot, and engaging with them seems pointless as it gives them a platform to disseminate false information. Any views on this?
Yes, I've actually been on both sides of the fence within my career. I've been acquired, and on the flip side, we've done the acquiring many times, and it is very interesting when you're involved in an acquisition. You do hear a lot of that on the telephone. I think at one point I was getting probably half a dozen calls a day, all asking me the same question because there happened to be an inaccurate rumor floating around that we were not in a position to receive Hart-Scott-Rodino approval, and that actually ended up being false. I think once you file the merger proxy, there is nothing much more you can incrementally say because that would be a violation of Reg FD. I think folks will continue to fish around to see if you will say anything incremental and if something sticks. So my suggestion for that is continue to work with your legal and corporate communications department on a statement that can be used broad-based for investors and the media, and you stick with it. And if you sound like a broken record, especially while waiting to receive HSR approval, then finally you receive it and then you issue an 8K on it, then it is what it is. But you're really limited to what you can say, and then hopefully at that point, once you issue the 8K, hopefully the calls will stop. But it is an interesting situation when you're involved in an acquisition. But if there was anything incrementally new that you could say, you would have disclosed it already in the proxy. So I think the best way is to return each phone call and do your best to contain the rumor and stick with a statement that has been approved by legal and make sure you and the entity that you are acquiring uses the same statement, and as well as your corporate communications team. That would be my suggestion.
Okay, thank you, Victoria. I mean, it always amazes me when there's a company in play, the degree to which their shareholder base just seems to get hijacked by the merger arbs. It's amazing the proportion of shares that really quickly get into their hands, and it seems such a shame after spending years building up your stable, your diverse, your long-term shareholder base. All of a sudden, 30, 40, or percent or more is in the hands of these short-term merger arbs who, as this questioner said, do a lot of shouting. It just seems so, it must be very frustrating for an investor relations officer. Let's go to one more polling question. Sorry, Victoria, were you going to add something?
I was going to say something. I apologize. One thing I did remember was definitely, reach out to your sell-side analysts and even your top investors. If they're hearing the same rumor, definitely it's been filtered wide and deep as opposed to trying to contain it. And they will be your best allies as well. I mean, they will be there on the front run as well, helping you out. So I think in those situations, you have your relationships with the sell side, you have your relationship with the top shareholders, and if they're hearing the same thing that you are, then definitely, it's a little more widespread than you initially thought. And I would continue to touch base and stay close to them, and definitely, internally with your legal department and if needed, your corporate governance team, because at the end of the day, you don't want false information being out there in the market, and to your point, can manipulate the stock price, especially if you're trying to acquire a company.
Okay, good. All right, now let's take a polling question of the audience. Again, we ask our audience to participate in this, and this is about the format for meeting with hedge funds. So what do you think is the best format for meeting with hedge funds? Would it be a one-on-one during a non-deal roadshow? Would it be a breakout meeting at an investor conference, a group meeting, say on an NDR, like a breakfast or a lunch, or a reverse roadshow where sell side is bringing a group of investors into the company to meet with management? What about you, Jeff? I mean, would you, for example, one of the questions we had was, from the audience is, would you meet with hedge funds at investor conferences, and if so, as a group or individually? So how do you handle this, Jeff?
Yeah, we generally try to group a lot of the hedge funds, especially ones that we don't have a lot of experience with. into group meetings when we get to the sell-side conferences in order to free up more time, again, for our, long-term potential share owners. And you have to be aggressive with the sell-side analysts that are organizing these conferences because, they will give you a list of meetings that they have prioritized, and it may not meet your needs, and you need to be willing to go back to them and say, no, let's group these together, open me up some more slots, and try to get some more long-term share owners into my meeting schedule.
Okay, good. Let's take a look now at the results, what our audience says. And it looks like it's, again, a pretty even split here. Very little use of reverse roadshows in terms of meeting with hedge funds, but a good proportion of one-on-ones during non-deal roadshows or breakout meetings at investor conferences. I guess the most popular would be a group meeting. So as you say, Jeff, grouping them together. I heard an interesting example 2 weeks ago at our Euro Leaders think tank in London. There was one European company that used to meet a lot with hedge funds in group meetings, but found that the hedge funds did a lot of the talking at the meetings, and they seem to be pushing their own agenda a lot of the time. And so now they've got a policy of only meeting hedge funds in one-on-one. So kind of the opposite to what I think most companies would have as best practice.
Yeah, Neil, this is Jeff. That's an interesting approach. I mean, my history has been that meeting with hedge funds in groups seems to soften up their questions as opposed to making them harder. It seems like they're less likely to ask you, something that would be an FD violation if their competitors are in the room listening to your same answer. So doing the group meetings not only, I think, helps prioritize your management's time, but also maybe limits some of the tougher questions that would be where they would have the potential of doing some type of FD violation.
Okay, good. Here's a question, and this is about activist hedge funds. So the question is, do you find any value in meeting with activist funds, if only to try to educate them or change their mind about some aspect of your company? Now, I know, Victoria, you do monitor the threat of activists or the presence of activists. I don't know if you've had a particular situation with them, but I mean, how do you view the value of meeting with activist funds?
We have not had a situation with an activist shareholder, but I do have colleagues here in the Silicon Valley who have, and I think everyone seems to be of a similar mindset that, from an overarching corporate governance perspective, it is very important to be aware and monitor your shareholder base. If somebody is labeled an activist, it's because they chose to be an activist in a particular situation with a public company. Doesn't necessarily mean they're going to be an activist within your organization or go after your management team and ask for changes. So I think that's first and foremost important to differentiate. We do have shareholders who, quote unquote, are labeled activists that we have a dialogue with, but once again, they only become activists if there is something that they feel is not management is not appropriately running the business or the board or something like that. I think how you handle it is you do have a dialogue if somebody is becoming an activist and they're sending proposals to your board and they want to be considered during your next annual shareholder meeting. I think you need to continue to monitor your shareholder base. You do need to have an active dialogue. You do work closely with your corporate governance and your legal teams, and you can even get them on the phone and schedule a conference call with them, and if necessary, your legal counsel or maybe your CFO or your CEO if the situation is that intense, and you hire a good proxy solicitor. So I would do a combination of all those three things. But that's also part of just general good corporate governance that we should be doing all year round, even when it's not proxy season.
All right, very good point. Okay, let's take just a couple of last questions, and I apologize to any of the audience who have put in questions that we haven't had time to tackle. But here's one, maybe a good one for you, Jeff. FedEx is a very global shareholder base, and you have a really active international outreach program. And this question is, do you discriminate between onshore and offshore hedge fund entities when deciding who to meet with? So, I mean, how do you view the domestic versus international hedge fund community?
You know, our strategy with the hedge fund community domestically and internationally is really the same. Obviously, well, not obviously, but with our company, we haven't had a tremendous amount of corporate development events of large scale over the last several years, but there's always a lot of international corporate development rumors in the marketplace, and so there's always a lot of interest from international, especially European hedge funds to do meetings with FedEx, whether they're interested in FedEx or potentially one of our targets. And so it does seem, from my point of view, that the environment in Europe sometimes is a little bit more lax from a regulatory standpoint than what you face in the United States. And so we are certainly probably more careful when we're in that community about exposure to management when it comes to people that may be looking for information that's not publicly available.
All right, interesting contrast then between what the sort of regulatory environment, the environment overseas versus U.S. And relating to that, then one final question, and this is something I'm very curious about, and that is if either of you have seen any changes in the behavior of hedge funds, whether it's their style or just their tone, since the big, all the insider trading crackdown. So starting with Galleon and then spreading to a lot of other funds, and of course the expert networks. Have hedge funds change the way they behave? And there was an example of this at our West Coast think tank in Palo Alto in March. Victoria, you were there, and we heard one investor relations officer comment that there's just been less sort of back channel buzz between hedge funds since this all happened. There's a little bit less of the kind of broken telephone conversations you say where you get a call saying, I heard from so-and-so some rumor. And so the grapevine seems to be less active. But, I mean, are you seeing any other kinds of changes, Victoria?
I would agree. I am seeing less of that grapevine chatter happening. I think in general, can't really judge a book by its cover is a phrase I've been using to describe some of these investment firms. And it's not related to just hedge funds. It's all different investment styles. One firm or one individual within a firm, can't mischaracterize a whole sector or whole industry. So from what I've been seeing, I think on the flip side, I think I've noticed more interest in trying to figure out the longer-term strategies for an organization, what's going on with your company, what's your investment plan 3 to 5 years out. I've seen more of the longer-term, quote-unquote, interest pick up. I think some of the fast money isn't there as much anymore. We've had healthy markets since we've, especially in the United States, since we've kind of, gone out of our recession. I think people are spending again, and I think people want to know the health and prosperity of the markets. And so I think when they're talking to investors, they're talking to firms, they're talking to longer growth stories. They want to know what are you investing in now, but also how are you going to continue to grow your business 3 to 5 years out. And I personally love having those conversations, and I welcome them. And so from what I've seen, it's been more longer-term focused interest in the story, and I think less of the what's the latest rumor mill or the scuttlebutt out there.
That's a good summing up. But what about you, Jeff? Have you seen a similar kind of gradual change and seems as a bit of a change for the positive?
Yeah, I would agree completely with Victoria. I think whether it's a generational change that as the newer analysts that come in post Reg FD are less aggressive with their questioning about near-term events and more interested in the long-term strategies and opportunities, or if something internally is happening to that community that they're changing. But it's certainly over time, the dialogue with hedge funds and high turnover funds has gotten better, and and certainly there's more and more that we're willing to do meetings with management where we feel comfortable with those meetings.
Okay, well, Jeff Smith, part of the award-winning IR team from FedEx, thank you very much, and also Victoria Hyde-Dunn, Director of IR at Visa, and also speaking from her experience at McAfee and Providian Financial. Thank you both for a terrific job on the webinar today. Thank you very much also to our partner in this webinar, and that's Bank of America Merrill Lynch. We really appreciate your support. I'm Neil Stewart, Editor-at-Large, IR Magazine, signing off now. The replay will be available. Thanks for everybody for dialing in and listening.